Howdy everybody and welcome back to another stock analysis video. Today we're going to be analyzing the company Himax Technologies, which was actually brought up by Michael Hammett, where this was actually his second pick as to what I should analyze next. So let's take a look at this company when it comes to their fundamentals and see what we could say about their current share price. So with that said, let's get started with this analysis. We're going to come right into the calculator, guys, because, well, Himax doesn't actually pay a dividend. Ticker symbol of HIMX, market cap of $1.7 billion. PE, guys, of 3.46. So just based off of this PE, this is pretty much just telling me that at the current share price of $9.62, this might actually be a pretty decent buy in accordance to their earnings. However, this doesn't tell us the entire story, so we're going to take a look at other metrics like the free cash flow to make further assumptions as to where we would like to put this company at 4 years into the future. Since they do not pay an annual dividend, this means that their 5-year average free cash flow and just their cash flow in general is going into themselves to grow the business, to buy back shares, and to pay down debt. Coming over here now to some fundamentals, guys, starting of course with the net income as always. 5 years ago of $27.7 million to 1 year ago of $436.9 million. That is a whopping increase, guys, of 1,477%, which is just insane. Now, if you guys were to just take a look at this number verbatim, you would say, oh my god, that's amazing. However, if you take a look at the graph overall, you can see that this is not a good graph when it comes to their net income at all. Because, well, you see that 5 years ago they did do 27.7 million. Then 4 years ago they went down to, well, 8.6 million. And then 3 years ago they went down again to the negative 13.6 million. And then 2 years ago they went up to 47.1 million. And then 1 year ago they shot up to $437 million. Yeah, this is not as consistent as you would like, guys. Just because you have an increase of 1,400%, actually almost 1,500% on the 5 year, does not mean that you should buy it, because this only tells you from 5 to 1 year ago, you went up the entire story. If these numbers were to steadily increase over time, then I would be singing a different tune right now. But as it stands, guys, this is all over the place, not consistent at all, and definitely a red flag. When we come to the free cash flow, we see the exact same thing. Guys, the free cash flow I consider to be actually more important than that of the net income, because the free cash flow, it is what companies use to essentially do everything when it comes to their business. They use it to buy back shares, they use it to pay down debt, they use it to grow the company, they just use it for pretty much everything, to issue a dividend as well if they were to issue one. So this is by far the most important of their profit metrics. Now, we can see something very, very similar when it comes to the free cash flow, as we just saw with the net income, and it is not good. Now, on the 5 year, guys, they went from what, negative $9.9 million to 1 year ago of $380.7 million. That is a huge increase of 3,945%, with a 5 year average free cash flow of $76.74 million. Now, you're probably looking at this and you're like, wow, that is absolutely insane. Well, again, similar to the net income, right? You have negative 9.9 5 years ago, then negative 45.7 million 4 years ago, then negative 38.2 million 3 years ago, and then 2 years ago is when they actually went positive to $96.8 million, and then 1 year ago they just completely shot up to 380.7. Again, we see something very, very similar as to the net income. And in my personal opinion, guys, this is not something that you want to see when it comes to the free cash flow. I understand that it is an increase, however, this is all over the place and is very, very sporadic. And this right here is a huge outlier. The 1 year ago number is a huge outlier as to what the company's free cash flow is, because this doesn't tell you that they'll be able to do this within the next year, right? Or within the next 4 years either. Most likely, they'll stay within their average at around either the negative or very, very close to $0 when it comes to the free cash flow. So right then and there, this makes it a huge red flag, because this is probably not sustainable. And lastly, when it comes to the profit metrics, the revenue, we got 5 years ago of $685.2 million to 1 year ago of $1.5 billion. That is an increase of 125.8% on the 5 year. However, even though this one actually doesn't have any negatives, we can see that from 5 years ago to 2 years ago, they were essentially flat, right? Going from what, 685 to 723 to 671 to $887 million. So if it wasn't for this 1 year ago at 1.5 billion, then this trend line would actually be essentially flat. So once again, we see that the 1 year ago number is an outlier for this company, even in the revenue. Taking a look now at some balance sheet numbers, we got the total assets and liabilities. If we were to take these two numbers and do the difference in them, this would tell you whether or not the company is able to cover their debts. And you want a company to be positive in this, because if a company is not able to cover their debts, then if a recession hits, then, well, they will go under, right? So currently, they're almost at $1 billion when it comes to their assets minus liabilities, at $988.8 million. And to their credit, guys, they were still positive within the past 5 years as well. However, similar to that of the revenue, well, from 5 years ago to essentially 2 years ago, they were flat at around like the $480 million mark, and then 1 year ago they shot up to 872, and then today they are at 988. Again, how sustainable is this? I am not fully sure. Average total assets around 1.1 billion, average liabilities around $511.23 million. Doing this difference, we get $612.2 million. And now taking a look at the metric that people tend to overlook, not understand, or just don't even care about, and that is the shares outstanding. This metric tells us how much the company is diluting you as the investor. So you can see right here, they are issuing shares at a little bit of a percent, but nonetheless, they are still issuing shares. 5 years ago of 172.1 million shares to today of 174.7 million shares. Increase on the 5 year of 1.51%. And from the previous year to the current year, this is looking at 1 year ago to today, they increased shares at a little bit less than 0.25%. So as it stands, guys, they are issuing shares, but not a lot. So this is good, I guess, but not bad. Honestly, when it comes to this is by far like not as bad as it could be, right? They could have been a lot worse when it comes to the shares outstanding. And lastly, looking at the cash and equivalents, they currently have $378 million with an average cash of $207.4 million. Now time to make some assumptions, low, medium, high, using 3 different factors: revenue growth, projected share buyback, and the required rate of return. For the revenue growth, guys, we're going to be using Seeking Alpha's growth tab, looking at the revenue growth year over year and the revenue growth forward, and then making an assumption between those two numbers. And if you guys actually see this, we see that the revenue growth year over year is a whopping 63.18%, with a revenue growth forward of 20.07%. So these numbers are fairly wide apart. So it's actually a lot difficult for me to actually make these assumptions, because, well, the closer these numbers are, the easier it is for me to do it. Now, the projected share buyback, we just saw the shares outstanding graph, and based off of those numbers, we're going to make this assumption. And lastly, for the required rate of return, keep it flat 10% to match the S&P 500 on the best years. So for the low assumption, I'm going to say a revenue growth of 15%, projected share buyback of -1%. This means that they will issue shares at 1% within the next 4 years. This comes out to be a target share price, guys, of 17 cents. For the median assumption, revenue growth of 18%, projected share buyback of -0.5%. This comes out to be 19 cents. And lastly, for my highest assumption, revenue growth of 21%, projected share buyback of -0.25%. This comes out to be 21 cents. Now adjusting for debt, this is why we take a look at the cash and equivalents, and also why when you actually pull in the numbers into the calculator, you have to input the net debt, because we take the cash and equivalents, we add the net debt, and then we add that to the market cap. If they have more cash than debt, then this number comes up. If they have more debt than cash, then the number comes down. As you can see, it does come up by a significant amount for the low assumption of $2.49, median assumption of $2.53, and the high assumption of $2.58. Now, I personally like to add a margin of safety, 5, 10, and 15%, to this target share price adjusting for debt, just so that way we can cover all our bases and we don't overpay for something, right? So adding this margin of safety, this puts me to buy this company between $2.11 to $2.36 for the low assumption. For the median assumption, it is $2.15 to $2.41. And for the high assumption, it is $2.19 to $2.45. Guys, the current share price is $9.62. So as it stands, this is still looking like it's a very expensive company for what you're getting. So the fact of the matter is that you guys are probably looking at this and you're like, 21 cents, $2, what? How? This thing needs to drop so much. Like, this is clearly wrong. Understand how discounted free cash flow works. It is taking the average 5-year free cash flow and then projecting that into the future based off of these assumptions, based off of these revenue growths. So we just saw the free cash flow, guys, right? The free cash flow, it is not good, and the revenue growth is also not really good either, right? Just because you have these outliers doesn't necessarily mean that they'll continue to be doing this within the next 4 years. So you have to take into account the average. And when you take into account the average, then, well, you can pretty much just see that this is essentially going nowhere, which is why these numbers come down this drastically. So as it stands, guys, when it comes to this, yeah, this is not looking good. And for me, it is not a buy at all, right? Now, if you guys don't believe my assumptions, if you think I'm wrong, then by all means, guys, I have this calculator available for free. Anybody can have it. All I'm asking for in return is just help me grow my channel, like, subscribe, comment. That's about it. So let's just say that you don't believe my highest assumption of 21% and the predicted share buyback of a negative 0.25%. Let's just say that you actually think that they'll do at around the year over year that you saw in Seeking Alpha. So let's put them at around 55%. And let's say that you think that they'll buy back shares at 1%. Well, if you do this, now the current share price is 54 cents for the target share price, not adjusting for debt, and $3.26 adjusting for debt. So I understand that it's still fairly low. However, compared to what it was, well, it is essentially a huge increase, right? That is because every investment, guys, is the present value of all future cash flow. None of this is financial advice. All I'm showing you guys is the raw data with these graphs, as well as my assumptions right here. You should not follow my assumptions. That's why, again, I have this calculator for free. Have it for free. Make your own assumptions. It's in my calculators playlist with videos on how to actually set it up and all that good stuff. I have this one, a book value one, a REIT one, and a dividend tracking sheet. So if you guys want all of those, you guys can have it. It's for free. Just again, help me grow my channel. Like, subscribe, comment. That's about it. All in all, when it comes to HIMX, honestly kind of underwhelming, guys. I never heard of this company before, and the fact that it is, this bad when it comes to their fundamentals, I'm personally passing on. On top of that, they don't pay out the dividend, which honestly, I'm glad that they don't pay out the dividend, because if they do, whew, that would be awful, right? They do not have the cash flow to pay out the dividend at all. So as it stands for me, their metrics are not that good, and seeing that they don't pay the dividend, it's essentially out of my ballpark. Now, if you guys like this company, if you guys get different numbers, or if you think I'm wrong on something, please let me know in the comment section below. But for me personally, I am not buying into this company. If you guys want to buy into it, then by all means, go ahead and do so. That pretty much does it for this video. Like if you like, comment, subscribe. It really does help here with the algorithm on YouTube, as I said. You guys can follow me on my new tech sites also. All links in the description below, as well as my Let's Play channel. The link is also in the description. So if you guys want to follow me there, you can follow me there too. With that said, peace out. Be on the lookout for the next stock analysis video.